Welcome back. Today, we're looking at an analysis of AMC stock.
Yeah, a piece arguing that $2.13 is the ultimate buy zone.
A classic high-risk, high-reward thesis. So let's get right into it.
Okay.
The analysis does a really excellent job detailing the fundamental successes. The Q3 numbers were strong.
Oh, for sure. Beating estimates, record spending per person, all good stuff.
But the foundational issue here is that the piece struggles to structurally establish the high-risk side of that high-risk, high-reward argument.
Exactly. And that's the core weakness. It celebrates that incredibly low 0.22x price-to-sales multiple as a distressed opportunity.
Right.
But it fails to explicitly connect that number, or the 45% YTD drop, to the actual financial pressures.
You mean the debt?
The debt. It doesn't quantify the magnitude of the debt that fundamentally justifies such a low valuation. It makes the thesis feel a little, one-sided.
So the suggestion isn't just to mention risk, but to make the risk the very engine of the reward thesis?
Precisely. You need to immediately quantify the core reason for that 0.22x valuation. That's what sets the stage for the dramatic upside.
Okay, so give me a concrete example of how to do that.
Well, for instance, you could weigh that $400 million in cash liquidity directly against the sheer volume of outstanding liabilities.
I see. So you frame that distressed PS ratio not just as a bargain, but as a direct reflection of a specific, almost existential hurdle.
An existential debt hurdle that the 2026 recovery has to overcome. It makes the entire argument so much more robust.
Okay, I get it. So if we nail down that structural risk, let's look at the timeline. The analysis highlights the Q3 strength, which is great, but then it relies almost entirely on a recovery way out in 2026.
Right, and that dependence on 2026 creates this unnecessary timeline gap that weakens the urgency of buying in now, at $2.13.
It feels like a huge leap of faith.
It is. The weakness is that the argument just skips over the immediate necessity of the Q4 content slate to bridge this period.
Which leaves that double-bottom technical setup feeling fundamentally
unsupported. It's just sort of floating there without a near-term catalyst.
But isn't that long-term potential the whole point of a high-risk play? Where do you draw the line?
It is, but you need a credible bridge to get there. So the suggestion is to demonstrate how success in the immediate future, in Q4, can stabilize the stock before 2026.
Make it actionable now.
Yes. Specifically detail how the massive Q4 content slate, we're talking about huge titles like Wicked or Mufasa, how they must perform.
To prevent that technical breakdown below the $2 stop loss you mentioned.
Exactly. You have to explicitly tie those Q4 performance indicators directly to the technical path toward the $3.50 plus targets.
So to summarize, the essential revisions. First, integrate that downside risk much more explicitly into the structural framework.
Right. That way the high-reward thesis feels earned, like it's been properly tested.
And second, tighten the causality. Make Q4's execution the crucial link between the current price floor and that eventual 2026 recovery.
Fundamentally ground that ultimate buy zone with some immediate, tangible catalysts.
Refine those sections. Submit your updated analysis, and let's continue strengthening the thesis.